So thank you for joining us, everyone. I'm Debbie Fales, Director of Marketing and Communications here at NavCap. Thank you for joining our monthly live call for our brokers. Before we begin, I just want to point out that you may submit questions during the talk. There's a little chat with everyone button on the lower right-hand side of the screen. It looks like a little thought bubble. And we'll answer the questions as we go, or Middie will get to them at the end of the presentation. And just a side note that I'm recording the call so that I can send out a recording to anybody who wasn't able to attend the call today. Or if you don't feel like taking notes, you'll have the call to refer back to later on. So now I'd like to introduce our guest today. Kris Anderson is head of the Anderson Agency and provider of specialty financial insurance to industry professionals, including real estate investors. Kris is going to talk about giving you actionable and cost-saving advice about mitigating risk for you and your clients. So now let me turn it over to Middie Rall, who many of you know already is our business development director for brokers. Middie?
Thanks, Debbie. And I just want to say I appreciate everyone taking the time out today to join this broker call. I know we're all trying to stay as busy as possible and get as many deals closed as we can. I believe that this call should be beneficial to all the brokers that are on here and all the brokers that will see it. I want to say thank you to Kris for joining us today. Really appreciate you taking the time as well. If you don't have my contact information, again, my name is Middie Rall. You can reach me directly at 443-228-8182. My email is middie@gonavcap.com. I want to emphasize it's an open door. Whatever you need or what we can help with, I'm happy to run through it and help. Like Debbie said, the call is recorded, so you will have access to this after we finish the call. And also on the bottom right-hand side, there is a chat box button. Throughout the call, if you have a question or concern, please put that in the chat box. You can also click the raise your hand button, and we'll be happy to get to you and go through whatever you'd like. Moving forward over to what we're going to talk about today, just the specifics of our fix and flip, hold, DSCR, long-term rental products, new construction, and multifamily program specifics, qualifying for them, and just some underwriting things that could be useful when talking to your borrowers. We're also going to talk with Kris today about how to bring value to your clients with his expertise. He's been in the business over 20 years. He is one of my favorite people in the industry, just a pleasant guy, and really, again, appreciate him taking the time, and he really knows what he's talking about, and he can give you some insight when you're talking to your clients, when you have your deals in the pipeline that you're trying to move forward, and just some things that bring value to them and maybe save them a few dollars and or help them qualify and get their deals done. At the end, if you have any scenarios or deals that you want to run through, I am happy to run through them and would love to. Also, if there's any questions at the end, happy to go through that as well. Want to move forward to our lending products that we have available and where, what areas we cover. We're based out of Annapolis in Maryland, so we're based out of the Mid-Atlantic. We lend in 37 states plus the District of Columbia, so we lend out to Colorado. We don't lend in New York, Minnesota, North and South Dakota are really the highlights in between here in Colorado. Also, just want to give you a heads up, we're a residential lender. We do work with multifamilies up to 20 units, but we do not specialize in lending on mixed use or commercial buildings. One thing that I want to let you know, if you don't already know, we're a direct private lender. So we're not a mortgage broker. We're not a table funding lender. We have an in-house underwriting, processing, funding, post-close, and renovation/draw teams that are going to be there for you and your clients. We want to be there with you from the time your deal starts to the time your deal expires. And whatever we can help with, we're happy to do so. Our products range from short-term buy, fix, and flip, buy and hold, bridge, new construction, all the way out to the 30-year long-term permanent DSCR financing. Just to touch on expected time frames that we can get your deals done. To let you know, for fix and flip and bridge on those short-term, it should take from anywhere to 1 to 2 weeks. For new construction and the DSCR rentals should take from 2 to 3 weeks at the most, especially on the DSCR. I mean, if we get the appraisal out of the way up front, you should be much closer to that 2-week time frame. And any multifamily deals, probably going to take around 4 weeks. Just to let you know, if you're looking for pricing on those, I have to take them to executive committee, so it could take a couple days. Just want to set expectations on that pricing. Don't want to leave you hanging and having you think that, or having you let you know, having you let your borrower know that you're going to get pricing today, when in reality it may be 2 days down the line. Moving over to the buy, fix, and flip / buy and hold product, a few qualifications that we look at. We work with first-time borrowers. We really exclusively lend to LLCs and corporations. You know, as far as credit is concerned, for first-time borrowers, the minimum score is right around that 680 mark. If it's give or take a few points, we can take a look to see if we can get it done and get an exception. If you have an experienced borrower who has 2 or more flips, 2 or more holds, or has other experience, I would say the floor is right around that 650 marker. We qualify on a few things on this. Obviously, the experience, the credit. 2 months bank statements are what we qualify for financially, pretty standard in our industry. And we also take a look at the property itself. So we're looking for properties in urban, suburban areas, properties in neighborhoods. Generally, if you look at the property and you think that the majority of America could qualify for and live in, you know, without personal bias, that's what we're looking for. So nothing on a 2-lane highway in a sparsely populated area. As far as terms go for this product, the minimum loan size is $75,000. We go up to $3 million on the buy and renovate. These are 12-month terms, no prepay or collected, 3 months interest at closing. The max LTC that you're going to see for this product is $9,100. I will tell you, someone who's going to get that $9,100 is going to look something like 5 completed flips in the last 36 months, a 700 plus score, adequate, reserves, liquidity, etc. And it's going to be a property in a neighborhood, urban, suburban area. First time borrowers, you're really going to see with that 680 plus score up to 80% loan to cost. If they have 2 or more flips in the last 3 years, you're going up to 85, and you really see 90 once you get to 4+. Rates in the fix and flip range are from 9.75 to 12.5. I will tell you the 9.75 is a little bit of a buy down. We have a buy down option for that. But if your borrower is extremely sensitive for in this marketplace, that's something I'd love to discuss and see if there's a fit. Please keep in mind that the loan to after repair value on this product is capped at 75%. Is not, what we create the loan amount at 75%. It's more of a cap on that upfront loan to cost. So just want to make sure that the borrowers have margins. And in reality, we all want our borrowers to have margins, because if they're not making money on their deals, they're not going to be around for long. And we want to see our borrowers genuinely be successful on their flips. Another piece of information for this buy, fix, and flip, buy, and hold product, we will go up to 20 units on the buy and renovate. Generally, I'm seeing 65 to 70% max terms approved on those. But if you have something of that size and a borrower who has liquidity to make that happen, would love to take a look at it. As far as underwriting is concerned, these loans take about 7 to 14 days. We touched about that. We can really move as fast as you and your client push along the conditions, title, and the appraisal. One thing I would say is, especially with your newer borrowers, providing a clear, concise scope of work is very important. It's going to be important to their after repair value, and it's also going to be important after we all get paid and they're working on their property and they're getting reimbursed for the work that they're doing. Few other underwriting bits. These are, across a few of these loan options. They can't have any history of financial crimes or felonies, a pattern of felonies recently, or have open liens or judgments. Borrowers need to be 2 years outside of a bankruptcy and 4 years outside of a foreclosure. That's pretty standard, and that's seen across all the short-term products that we have. Moving forward to the new construction product, one of the biggest barriers to entry that you see for this and getting someone to qualify and getting terms and being able to move forward is they need to show that they have experience in the last 3 years of doing at least 2 new builds or ground up new builds. They could have bought the land, built the property and sold it. They could have bought the land, built the property and refied and held onto it, but they need to be able to show that. The floor credit score for getting in here is 680. Again, we're lending to LLCs, and the financial qualifications are not tax returns or DTI or looking at 12 months. We're looking at the most recent 60 days of bank statements. Terms for the new builds are 12 to 18 months. There is no prepay. This is really geared towards 1 to 4 units. I will tell you, I just had approval for a 9-unit new build. So it's at a little bit less leverage than that 85% loan to cost, but I believe it was at 80. So we can do larger deals of that nature if the borrower is qualified and they can show that they have a clear plan of what they're doing and they know what they're doing. Loan to cost max is up to 85%. Keep in mind that, when we're looking at the loan to cost for new construction, we're looking at the land value or purchase price, the lower of the two, and the construction costs. That's how we're figuring that loan to cost. For non-Dutch interest, in layman's terms, this is paying only on interest drawn out instead of paying on the full loan amount from day one. It is available. I would say that they need at least 3 new builds in the last 36 months to really get that. And it costs an origination point up front, but it is a valuable option when you look over the life of the loan, especially on larger deals. The LTARV is capped at 70% for these loan products. A few underwriting pieces here that we've seen and that I've seen in particular with our brokers is we get some requests for luxury, larger mansions or luxury homes. It's really not geared for that type of new build. I would always emphasize, please bring any scenarios that you have to us. I'm happy to get them priced out and get you an up or down on what we can do. But that's just not really the ideal fit for the program. If the lot is already owned, it depends on how long they've owned the lot. If they've owned it for 5 years, you may be looking at a different appraised value. But if you have the borrower buying it, in the last month or two and they really haven't done much to it, we'll typically use the lesser of the appraised value or the purchase price. Another bit is the borrowers really need their drawings and plans in place to get an appraisal done. One thing that I've seen is some borrowers, in particular, have tried to push this file, along and get it closer to close, but they don't have the necessary items that we need to get an appraisal ordered, which is one of the larger time frame barriers to getting these done. With regards to appraisals, before I move over to the DSCR rental, our appraisal time frame is typically 3 to 5 days for bridge, new construction, and fix and flip. I would say the new construction is generally closer to that 5-day period, but it is much better than dealing with your traditional AMC 1004D or the new build. Want to move over to the DSCR rental. Just if you don't know, debt service coverage ratio is what DSCR stands for. This is a 30-year product. It really qualifies on prior experience, the borrower's middle credit score. For some programs, it's going to take, if there are multiple borrowers, the lower of the middle credit score. And other programs that we have, we can take the higher of the middle score of the borrowers. That's a valuable asset to have in some of the programs. And it qualifies on the DSCR. In plain, the DSCR is looking at what is the monthly rental income for this property as opposed to PITI payments, so principal, interest, taxes, and insurance. We go down to a 0.75 for DSCR. I will tell you it's not the cheapest option when you're at a DSCR below 1, but it is an option. Typically, your borrower should at least want a 1-to-1. Generally, your borrowers are looking, and I don't want to specify or generalize everyone's borrowers, but the reason why they have a rental property is to produce cash flow, gain equity over time, etc. So just my 2 cents on that. One other thing for them to qualify is they at least need to own 1 other property before they buy this rental. It could be another investment property. It could be their own primary. I will tell you, if it's their own primary, they're going to need to have a clean pay history. Generally, their pay history will show up on their credit report. So that will check the box right there. But if it doesn't show up on the credit report and they own that, and they own their primary, we're going to look for a VOM as a funding condition. As far as terms are concerned, loan sizes are from 100,000 to 2 million. We have a 1 to 4 unit product, and we have a 5 to 8 unit product for purchase only. So no refinances for multifamilies. We have both 30-year fixed and a 10-1 ARM. We also have a 5-1 ARM as well. I want to say the cap on the 5-1 is a 225 and 10-1 is a 525. We have interest-only options on the 30-year fixed. So you can do either a 5 or 10-year interest-only option on that 30-year fixed. It will be ITI for, let's say, 5 years, first 5 years of their note. And then for the remaining 25, that principal will be ammed over that 25. Nice option, especially if you're looking for cash flow and you have a 5-year prepay. And once that term comes up, they could refi out of it if that's something they're looking at. Purchase and rate and term refi loan to values are up to 80%. Cash out is at 75. Rates for these, they're based on the 10-year bond yield. It's been up a little bit this week, was up last week. I would say today they're starting at 7.625. This product does have a prepayment penalty. Just to let you know, we have options for a shorter prepay than 5 years. But once you start cutting down on that prepay option, your pricing will increase. Otherwise, we have yield spread available to you. It's a 2-to-1 upsell. So let's say we give you a rate at 7 3/4. If you go up to 8, you're earning half on the back end. Keep in mind that you are getting paid that YSP when the deal gets bought on the back end. You also, another nice option that we have here with taking of the higher credit scores on a 10-1 interest only ARM, you can also qualify on the ITI payment for DSCR. So to clarify, if you have a larger size loan and it is not qualifying DSCR wise on PITI, you can qualify on an ITI payment. That could be very useful, especially in tight DSCR scenarios. A few underwriting bits about this. Property needs to be in a condition to rent. If it needs renovation to get to that point, this is not the right loan for your borrower. Generally, the borrowers need about 4 months reserves typically, but they can need up to 6 months of payment reserves liquid. We are not collecting any payments at close for this, etc. I touched on the pay history for their primary. And if you have a borrower who wants to refi a vacant property, we have that available. Typically, it's subject to a 5% LTV reduction. So let's say they qualify for 75%, but the property's vacant. They can get a cash out at 70%. Lastly, want to move to the bridge loan that we have here. This is very similar qualifying for the fix and flip. Keep in mind that the leverage on this product is going to be lower than a fix and flip because we're not counting on renovation and built-in equity from that renovation for the product. New borrowers, as repeating in the fix and flip, 680, experienced borrowers, 650, looking in urban and suburban areas. Max LTV for purchase is 70%, on exception basis 75, cash out refi is 65%, rate and term is 70. Loan size is up to $3 million. It starts at $75,000. 12-month term, no prepay. It's a fixed IO payment on these, and rates are really starting at 10.5. As far as underwriting is concerned, just one thing that you want to note, bridge loan can be used in many different ways, from a refi to I've got to acquire a property and stabilize it in a pinch, or I want to do my own renovation. There are many variations how you can use a bridge. So it's always good to have a clear idea of what the borrower is going to do and what's their exit strategy, because at the end of the day, this is a 12-month balloon. So they're going to have to pay this loan off within those 12 months. I would say, this is generally the easiest file we can complete, and it should be the quickest file because you're not counting on value add. We touched on the turnaround time frame for appraisals. 3 to 5 days is typical for those. And I want to move forward to introduce our special guest, Kris Anderson. He's part of the Anderson Agency Group. I know Debbie touched on that. His contact information is seen below here, as well as his website. Kris, I really just want to say thank you for joining the call. And I've got some stuff on your background here, but if you want to touch base and introduce yourself, please feel free to go ahead. Take it away.
Yeah, absolutely. Thank you. Thank you, Middie. I appreciate you guys having me on the call, and everybody at NavCap too, inviting me here to speak about everybody's favorite topic, which is insurance, right? So here we are. So we're a 43-year-old family agency. We've been independent for those entire 43 years, and we're a brokerage, for lack of a better term. So what we do is we take policies and applications, and we farm those out to a whole bunch of different wholesalers and carriers, and come back with the best quote for those borrowers. And we're always on the outlook for new products, new opportunities, new carriers that are in this space that have an appetite for this space and this product. Insurance is a lot like lending to where it's you ride the wave too, where some carriers are heavy in it, and then they decide they want to get out and not take as much risk on, and maybe in certain markets or just in certain lines of business. So we're always trying to find what's best and stay 1 foot ahead of the competition, and help you guys best we can reduce those insurance costs and cover everything the best way that you can to mitigate the risk. And we know that insurance is an expense at the end of the day too. So any opportunity we can to reduce those costs and get a policy that will match up, that's what we're trying to do. So, but yeah, feel free to, my contact number is there, email address is there. Any questions or anything you want to just ask me or talk through, I'm happy to have the conversation, or that is my cell phone number. So you can also text me if you need to too. So I know everybody likes to text these days, so I respond to those pretty quickly. So yeah.
You can call Kris at any time of the day, 12 o'clock in the morning. He'll be there to answer your call.
That's right. Pretty much.
We've talked about a couple things, and when discussing bringing value to our borrowers when it comes to insurance, we had a couple topics that I thought may be prudent. The first one is the debt service coverage ratio. Your taxes are set. Your P&I is generally set on these. From your perspective, we see higher deductibles, maybe a lower rent loss figure. Typically, a lot of lenders need 6 months. I haven't seen many that need more, but I could be wrong. I'm not all knowing with that. What do you see, especially in that long-term rental, how we can bring our premiums down as much as possible?
Yeah, that's a good question, and that's what everybody's trying to get to, right? So there's a couple endorsements, or some carriers will call them add-ons or options to a policy that can help. Loss of rents is one. Some carriers will specifically require a 12-month loss of rent, so they're going to match it up with whatever that monthly rent is. So you're going to have to pay that much. So then their mindset it is, well, if the house burns completely to the ground and it takes us 9 to 12 months to build that back, then you're going to want the loss of rents coverage for that for its entirety. So that's kind of the mindset there with some of the carriers. But you can get the 6-month loss of rent. Others will have options too, with sewer and water backup. Sometimes that's an endorsement that can be added and removed, and you're looking somewhere around 3 to 5% what that premium amount is going to be in addition to it with the sewer and water backup. And then the same thing with ordinance and law coverage. So, and just to hit on those real quick. So sewer and water backup is anytime water is flowing back up into the house through through a toilet or a sink or a tub or anything like that, then that's what that coverage is going to cover. So, and it's inevitably happens to where with the sewer and water backup, somebody flushes something down the toilet that doesn't go all the way down or doesn't need to be there, and then that renter leaves for a week and comes back and the bathroom's floating. So that's where that sewer and water kicks in, because there's more damage there than if it just sat there for a day or two. So, and then ordinance and law is anything that's an older home, and usually we kind of use the rough estimate. If it's 25 or 30 years older, we like to add that coverage just because it's going to bring the house back up to code if there is a claim. So, and that can be a multitude of different things. I mean, some of the homes that we're quoting right now are in 1900s to 1950s. So all of those, we like to add that, but that's something that you can remove. And again, it's typically 3 to 5% of what your premium is going to be to help reduce that. Contents coverage is another one on those DSCRs. So if it's a short-term or a long-term, sometimes they will have the contents coverage on a short-term rental, just because some of the things that aren't tied to the actual structure are theirs, call it couches, beds, anything like that, then your contents coverage kicks in for those. So that's something that you can leave off if you don't need that coverage. That can help reduce some of the costs too. So, but those are the main things. The one thing that we don't want to run into is the replacement cost value there. So the replacement cost value can cause co-insurance to happen. And I know, Middie, we were going to talk about that in a couple ones down there, but that's something you want to stay away from, or if you can self-insure some, then that's a good way to keep that cost down too. So an actual cash value is a way of doing that on the roofs too. So you can get an actual cash value policy for the roof, and that can help reduce some of those costs for the insurance.
Okay.
Mm-hmm.
Yeah, I mean, when you're tied against the DSCR and you have to adjust, and you can adjust from 6 to 10%, that doesn't sound like the largest thing in the world, but in real dollars, when you're tied up against that 1-to-1, that's absolutely something that is useful. Insight, because I didn't even know that. The second one that we really run into, and I get question-wise, is especially with our borrowers who kind of know what they're doing and know their time frames for fix and flip. They know they're going to be out of there in 4 months, allegedly, but in most cases they are. Is it a good idea for them to get a prorated builder's risk policy? Does that add value to them? Can you touch base on that? Because I tell my borrowers that they may want to look at a prorated builder's risk policy, but I also know that there are minimums earned on that, and if it makes sense actually in the long run. Yeah,
no, it does, because it's down to the day with a prorated. So the only thing you're going to be out of pocket, or whatever fees that particular agency or broker is going to charge you. And not all of them charge a policy fee or a brokerage fee. Some of them do, some of them don't. But when it is a prorated, that's the only thing you're going to be out of pocket. So if you use 6 days or 60 days or 360 days of that policy and then cancel it, you're going to get the remainder of it back minus those fees. So we don't charge any of those fees on ours, but that's a good thing to look for. And on the fully earned, it's going to be in red, typically in bold or an asterisk or something. And most of them are 25% fully earned, or they're going to want at least 3 months. So if it's a 6-month policy, it'll be 50% fully earned. If it's a 12-month, it will be 25% fully earned. But if you're only going to be in there for a month or two and get out, then you're going to pay that full 3 months as a minimum on those. So yeah, that's always something to look for.
Okay. Okay. Thank you for clarifying that. Lastly, I know we've talked about some policies that you like that you think borrowers should look at, and then other policies or parts of policies that they should stay away from. Can you mention the ones that you like, in particular the portfolio policy for the rentals?
Yeah, definitely. For the rentals and even for the rehabs too, a portfolio policy is going save your investors a whole lot of time and a whole lot of money, because you typically will get an investor that's got 10 or more properties that's doing fix and flips or fix and holds. You can put them on a portfolio, and every carrier is different. And obviously every market is different, because Florida right now is Florida, and it's very difficult. And parts of Texas are becoming that way too, and other parts of the coast on the East Coast. But beyond that, you're going to see some substantial savings from a 10 to 20, maybe even higher percentage wise on those premiums when a carrier can get an entire portfolio as opposed to just one property on a policy. So that's definitely a good way of doing it. And with the portfolio policy too, that can be multiple states, multiple LLCs, multiple mortgagees, and we bill all the escrow. So we're kind of an outside insurance firm for them at that point. So saves them time, saves them money, saves them headache.
Now let me ask you, I know we're running up on time here, but let me ask you, if they have a portfolio and let's say they sell off a property, one of the things that you look at is the partial releases on the mortgage. If they sell off a property and it's no longer part of the portfolio, does that screw everything up? Is that okay with the policy?
Yeah, that's okay. No, great question. Yeah, so it's a prorated policy too. So typically what happens with my portfolio customers, they send us an email and say, hey, we sold this on this date. We get it canceled, get it taken off. And so that following month statement, they're going to see the adjustment on there. So, and it works the exact same way, opposite going the other way if they purchase one. So send us an email with that property, any information on it, and we get it added on the day that they purchase it.
Okay.
Mm-hmm.
Well, look, does anyone have any questions in particular for Kris? All right. If not, please take down his phone number. And like he said, you can call him any time of the night, and he's happy to talk to you.
That's right.
Hey, actually, I do have a couple questions, if you don't mind, Kris. It's Rick. How are you, sir?
I'm good, Rick. How are you doing?
I'm doing well. So just a couple of things, Middie touched on this, which is, especially there's no DSCR, there's no income requirements for our bridge, for the new construction, for the fix and flip. But DSCR does, sometimes we can use, and Middie touched on this, we can use interest only payments to help them qualify. But sometimes we're really tight. There are third-party costs that we're trying to control. Obviously, we can't control what taxes are, but insurance is one thing we can control. Are there any deductible amounts that you would recommend that, I don't want to say you can mess around with, but you could explore your options with, that would affect the premium? In other words, increasing deductible amounts. Do you see that as a useful tool to get a cheaper policy, or is that not advised?
No, it is advised, but I always explain to the insured, our client, the borrower, investor, in your guys' eyes, but I always explain to them too, if you do raise it, we offer $2,500, $5,000, $7,500, and $10,000 deductible. So the one thing to be careful of is they have to make sure they can self-insure for the amount, because we explain it to them, say, listen, if somebody comes in and steals, it just happened recently in Texas, somebody stole the garbage disposal, the dishwasher, and that might have been it. May have been there was another appliance in there, but stole all three of those things, and the investor had selected a $7,500 deductible. So, there was nothing we could do. Those things didn't add up to $7,500. So,
yeah, that's a great point. But sometimes the people, our borrowers want the loan, and they need to find a way to make it work. So it may be an option, but they have to be aware of just what you're talking about, that they're going to be on hook for that deductible.
Yep, absolutely. Yep. And so that's, as an insurance agent, we just have to advise them on that. But yeah, that is a way to definitely lower the premium.
Right. And just a couple other ones I got in chat here. Is there any difference in premiums for a borrowing entity, an LLC versus an S corporation or a C corporation? I haven't seen that, but it's a unique question.
It is a unique question. The answer is no. The only the only way to reduce those premiums would be if it's a portfolio policy. But
Portfolio process.
yeah, so from a S corp or LLC or individual, no, we don't. That's not a part of the underwriting for us on these loans.
Okay, and I think I know the answer to this question because we've dealt with this recently. What states are the hardest to get policies in now? And I would probably say Florida to start with.
Florida is by far and away leading this race. Yes.
Right.
Yeah. The coastal Texas is they're running out of wind capacity down there. So there's still a lot of carriers that are okay with it and don't have a problem insuring down there. But once a few start dropping, then the others start falling into. And plus, we just entered into hurricane season, so that always causes things to change too. So, but Florida by far and away. That's really it. Some of the bigger cities, when you're talking about rental properties in particular, some of the carriers will stay out of. Detroit, as an example, there are very few carriers that will do anything in Detroit, from a fix and flip, a buy and hold, anything. So that's a tough market.
Gotcha. So limit your options. Got it.
Mhm.
Just three more that I've got. In regards to flood insurance policy premiums,
Mhm.
since insured by the government, are the premiums standard, or are there different costs per carrier, per issuer?
So that's a great question. So it's the NFIP is what's the government. So that's the National Flood Insurance Program. So I don't know how many years it's been, but private insurers have been in this space for a number of years now. And there are well over 100 different private carriers in the flood insurance space. And so we rarely write an NFIP policy these days because there's so much competition on the private side. And the private side offers better rates, it's better coverage. So we've been, it's kind of funny, but it's easier to get flood insurance in Florida right now than it is property insurance. So make that make sense. But so that's so yeah, the NFIP is still good coverage, but if you can get a private market quote, you're probably going to save yourself some money.
Okay. And from your business side, do credit scores affect what is available to the borrowers, even though they're entities? And do you pull credit?
We do not. No.
Okay.
We do not. So that's where the nice parts about being in this space is, if you go into traditional owner occupied or homeowners insurance, they look at those types of things and auto insurance, but we don't. We can sit back and rest on what your guys' underwriting is with these types of products. So we know that you guys are diving deeper than we are. So we don't have to pull any of that stuff. So we don't do any of it.
Okay, one follow-up question with that. So if you have a borrower who has a primary residence in their basement flooded, they filed a claim, but now they have an LLC and they're doing a fix and flip, or they're doing a DSCR. Does that claim affect the policy premium for the entity's policy?
That's a good question. So that's on the house they live in, they had a loan on?
They had a loan on, let's say, their primary residence basement flooded. They had a heavy rainfall, whatever it may be, but yet now they want to go get a builder's risk policy, or they want to get a rental policy. Does that claim individually affect their options and costs for their new loan?
No, it doesn't. And especially on these one-offs is what we refer to them as. If Middie called me and said, hey, I've got a client that needs a quote for a property in Colorado, then we get that individual one quote. So we're not going to look at that at all. And even on a portfolio policy, we're going to ask for loss runs from their existing carriers, or have them sign a no known loss letter or statement saying that they've had no losses on any of their rental properties, not on their owner occupied, not their primary residence. That's a completely separate policy. So no, your house could flood and you've got 3 or 30 rental properties and you're trying to get better insurance coverage on those and rates. It won't matter that your house flooded.
Okay. That's all the questions I have in chat. So thank you.
You're welcome. Thank you.
Kris. I really appreciate you running through this, and anybody on this call. If your borrower needs a insurance contact, or if you need an insurance contact for your borrowers, I would highly emphasize to reach out to Kris. Great individual. Has placed numerous policies on my borrowers, and just been a pleasure to work with.
Thank you, Middie.
Okay.
I am going to move forward to just briefly, easiest ways to get terms from us. I'm going to keep this brief because we're 11 minutes over now. If you don't, for terms, you can get those through our web portal. If you don't have a member account with us, please email me and let me know, and I'll be happy to schedule time for a call and get you access. There is also a sign-up link that I can send over to you. But you can get terms for any deal that you have through your member account on our website, NavCap.com. You can put in a pre-loan application. It is going to ask about you, which is kind of tricky, but the about you is actually about your borrower because we already have you signed up as a broker. And you can input that information on the subject property, borrower's credit, experience, etc., and we'll get you term sheets, if not within the day, within 24 hours. These term sheets do not run credit. They don't start the underwriting process. We're just going to underwriting with the information provided and getting you over terms on what we can do. Lastly, I just want to mention that, your term sheets that are provided are going to be subject to the terms that you put in. So if you put in that the borrower has a 680 and they have a 620, terms are going to be much different if we can do that deal. Same case would be if they have, put in a 680 and they've got a 750. Terms are going to be more favorable on that end. Debbie, are you still there?
Yes, I am.
Is there any chance that you can put the white label marketing material in the chat for our brokers so they can download it?
Yes, I can put a link to that in the chat.
Okay. At this point, I just want to ask if anyone has any questions from what we went over today, or any deals, scenarios that they want to run through. We'll be happy to run through that at this point. Hey, Pilar. Go ahead. Is your regular fix and flip Dutch or non-Dutch? That's a great question. I would say, along with the new construction, if it's a high quality borrower, they've done a few flips before, they've got a higher renovation budget where it makes sense for it to be a non-Dutch, i.e. 50,000 plus in renovation, then absolutely we'll consider non-Dutch for them. That's not a problem. If it's a lower renovation budget, like 30 grand, unless it's a borrower that we've worked with and we like, I don't know if we're going to utilize non-Dutch for that. And if you got anything else, please put it in now. If not, I genuinely appreciate everyone taking the time today to join the call. I hope this helped and brought value for your clients. And we're always looking forward to talking to you next month. Pilar, as far as the construction loan, if I could, I'm going to shoot you over a chat to get your phone number, and we'll run through the construction program together. We went through it a little bit earlier in the presentation.
Okay.
Jacob, there will be a recorded version of this video. Absolutely. Yes.
Yes,
Thank
I'm going to send out the replay of this video tomorrow. So you'll have that. And I'll also include the links to the white label flyers in the email that I send out to everyone tomorrow. So if you have any questions about those, accessing them or editing them, just let me know.
All right. Thank you, Debbie. Let's close some loans this month. Whatever you got, please feel free to send it over, and happy to see what we can do. Talk to you next month.
Thanks for joining.
Thank you.